What's up everyone, it's Karthik with MoneyVest, and what a bloodbath in the markets. Almost over $700 billion worth of sell-off in the S&P 500. So very significant amount of selling pressure, more specifically on semis and technology. The Dow Jones and more specifically staples, defensive and energy parts of the market doing a lot better. So that's exactly what we're going to discuss in this video. It is time for us to start getting ready for the next more serious buying opportunities. I'm also going to break down exactly what that means from a MoneyVest index standpoint. But S&P 500, of course, in a weekly loss. The S&P 500 was down a little bit over 1% this past week here as inflation numbers came on par with expectations. However, PPI numbers came in a little bit hotter than what the consensus was. Not to mention, of course, Jerome Powell also coming in with some very hawkish comments around not rushing into those rate cuts and really allowing for the economy to really demand for those rate cuts, as we have discussed in our previous updates. So this right here is what the heat map looks like. Tesla was the only Magnificent 7 stock which was higher, up over 3%. But one more stock that just doesn't seem to stop at all, and that is Palantir, after the announcement that it's going to be added into the NASDAQ, up 11% here, one of the biggest gainers in the S&P 500. If you come take a look at the biggest gainers in the S&P 500, of course, Tesla was at the top of the list at over $33 billion, and the second stock was indeed Palantir, up $16 billion, market cap now eclipsing over $161 billion. This stock just doesn't seem to stop here. $65 per share is where it's trading at the moment. So Palantir jumping 11% to a record after announcing move to NASDAQ. We're also going to be including Palantir and SoFi into these market updates. So I'm also going to be going over those stocks as well. But the MoneyVest index has now come down to 3.57. We're still in the optimistic zone. However, we're coming down to a pretty neutral level. And the lower it gets down to, the better that's going to be for us as buyers to deploy capital into the market, because that all is going to be the risk reward ratio. That's what we're going to be focusing on as well. So $700 billion worth of losses here in the S&P 500. We've seen this before. We've been here before. And of course, the Magnificent 7 accounting for over $416 billion worth of losses. Top 10 stocks losing $427 billion, with Big 3 down about $250 billion here on the day. So significant amount of selling pressure here. NASDAQ down 2.2%, S&P down 1.3%, and the Dow Jones was down over 300 points on the day as well. Now, before we move forward, make sure that you drop a like and subscribe to the channel. I'm going to go over exactly what this is, and this is going to be super helpful for everyone who's a part of our community. We're going to be deploying this right here, the historical charts, and there's going to be a lot of tables down here as well for percentiles, for different MoneyVest index values, to give you a little bit of an idea of where we are and the number of buy signals that have been triggered by the MoneyVest index. So there's going to be a lot of new additions next week on the MoneyVest platform. So if you want to get access to all of this, link's going to be down below. We'd love to have you on board. There is a 16% annual discount that you can access until the end of this month. And of course, get access to the entire MoneyVest website, including all the Discord channels, the weekly options portfolio updates, trade alerts, engage with thousands of traders and investors, and of course learn investing and trading as well. So there's a lot of courses, 4 courses available: fundamental analysis, technical analysis, options trading, as well as psychology of investing. So that's going to be under the MoneyVest education tier. Link's going to be down below. We'd love to have you on board. If you have any questions, please feel free to reach out. And this right here is perhaps one of the most important indicators for me personally. This has been handcrafted, handpicked some of the indicators myself, built it into one really well back-tested indicator called the MoneyVest Index, which we've been tracking in our community for a really long time. And the moment it gets down to 3 or lower is the time to deploy capital. This is 2024. As you can see, there's only really been 2 very serious buying opportunities, one in April, another one in August, and looks like we're starting to come down again. 3.57 is where we are, still in optimistic zone. However, the moment it crosses below 3.5, we're going to be in that neutral territory. That's going to be this yellow zone. And of course, the lower we get down to, the better, right? So if we're going to be in those green zones, the better the risk reward is going to be for the market. If you go back to 2023, we did dip below 3 quite a few times. You can see this right here. There was a lot of fear and uncertainty in the market. This was back in March and April 2023. This right here was in October 23. And again, you go back to 2022, a lot of serious buying opportunities. So it's all about quality over quantity for us. We're not buying every single week or every single day. It's really when the Money Vest Index triggers certain values is when I am deploying capital into the market. So don't say that I didn't prepare you guys. It is really time for us to be ready to start buffing up our cash positions again so that we can start looking into the markets as the risk reward gets better, volatility spikes, and of course the markets come down. And this is not a surprise, right? This type of environment here, this is not a surprise. And this is going to be my message to all investors is this is a very, very normal market. This is a healthy market. If we were just going up every single day without any type of correction or pullback, then I would be a lot more concerned. Trust me when I say this in our Discord, I've mentioned this, I am more nervous and more anxious as the markets keep pushing up higher and higher and higher, because the higher we go, the bigger that pullback and that correction is going to be. It's just a good thing that we're seeing a little bit of a pullback. We're seeing this rally cool off a little bit so that everyone can take a break, we can recalibrate and start deploying capital once again. So if you take a look at some of these fundamental indicators as well, you'll notice that corporate insiders are also dumping shares at the fastest pace in more than 3 years. Now, this can be a little bit misleading as well, because a lot of these corporate insiders already have predetermined sales already executed at 2 years ago, 3 years ago, that are now only being carried out. So I think Jeff Bezos ended up selling over $700 million worth of Amazon stock. That doesn't mean that he's actively on his brokerage app selling his shares, right? These are already planned out by these insiders years ago, and they're just being executed now. So they really don't know what price is going to be when they're actually selling their stock. Money market funds also soaring over $7 trillion for the first time in history. There's a lot of capital, there's a lot of cash sitting on the sidelines, which also does, kind of tell us that there's no rush for investors to invest in equities right now. And for those reasons, I think the 10-year treasuries, of course, has been moving higher, 4.5%, and that's one of the reasons why the equity risk premium has practically vanished, something that we have talked about in our previous updates as well. So you can see that the equity risk premium, which is nothing but the premium that you're getting for investing in equities over bonds, has diminished down to pretty much zero levels because of the fact that the 10-year treasuries are sitting at 4.5% and the markets have been pushing higher and higher. So it's nothing but an earnings yield and a combination of earnings yield as well as the 10-year treasuries, and that of course has been coming down, meaning that there is no attractiveness to investing in equities over bonds, and that of course has been coming down. And that's one of the reasons why we're seeing a little bit of that flight to quality again, where investors are indeed dumping equities in favor of certain other asset classes that are more risk-free. In other words, there's less risk, less volatility for equivalent amount of returns or more. So right now, 59, almost 60% probability that we're still going to see a rate cut, but 40% are expecting for no change. And there's now starting to increase probabilities for a rate hike as well, which is obviously something that we were kind of dreading from the beginning, is that if inflation really starts to accelerate back higher, whether that's through deficit spending, whether that's through oversupply and issuance of bonds, lower interest rates, whatever the reason might be, if there is any type of an acceleration on inflation, then that of course is not going to be good news, because the Federal Reserve, it's going to be very quick to pivot policy again from quantitative easing to starting to raise interest rates once again. And this right here was another chart that was shared by Isabel Net, and they pretty much talked about how equities in the US stocks are nearly 60% premium to global stocks right now, trading at an insanely high valuation, because this is the world excluding US, and this is S&P 500 forward PE, which is now closing in on 24, versus where the markets are trading, excluding United States, trading at 14. So that is a significant PE ratio of 1.6, in other words, 60% higher than the global world indices, excluding for the US. However, I would also argue that the reason why the US trades at such an expensive valuation to begin with is because it is dominated by 7 of the largest publicly traded companies in the world that are pretty much around with their products and services. Everyone in the world uses them. You guys know what I'm talking about. Apple, Microsoft, Amazon, Google, Meta, Tesla, Nvidia, all these companies have got the largest use cases around the world, and that's why they do deserve a premium, because of the higher margins and the higher profitability. But that being said, that doesn't take away from the fact that fundamentally, yes, we are trading at a expensive valuation. I wouldn't necessarily call this at super overvalued, but yes, we are expensive, and technically we were overbought, which is why we're seeing a little bit of a pullback, which is very normal. And this right here is Goldman Sachs S&P 500 levels, as well as earnings per share at $6,241 in earnings per share for 2020 2024, we're looking at a PE multiple of about 24.8, a little bit under 25, and that's exactly where we were up until the S&P was at 6,000. Of course, after today, it has sold off quite a bit. It's trading down to 58.70 now. So 58.70, and that valuation multiple has now compressed down to around 24.3. We're still above 24 right now, despite this pullback on the day for the S&P, down about 1.3%. So coming over to VIX, we were up over 12%. At one point, I think the volatility was up a little bit over 19%. So a lot of momentum to the upside, trading up to over 16. Not to mention, of course, MoneyVest index coming down to 3.5, and Bitcoin here continues to be the best performer. The risk on rally on Bitcoin continues at over $91,000 at the moment. Of course, crude oil here selling off even further, which is good news for inflation, as energy prices have been one of the biggest leaders for this disinflation. They've already been in deflation for a really long time, so now trading at under $67 per barrel at the moment. Now, 10-year treasuries, that's been one of the biggest culprits why we're seeing such a pressure on equities. As I mentioned before, eventually it is going to play a bigger and bigger role as to how equities end up doing, and it is trading at just a little bit over 4.4% at the moment. So again, causing a little bit of problem for equities as well. And not to mention the dollar index also has been spiking. I mean, take a look. It's gone from 100 to 106. There's been a 6% increase in the dollar index. So dollar has been strengthening against foreign currencies, and that, of course, even for large caps, have not been great news because a lot of their revenues actually comes from foreign countries, right? So when they convert that back into US dollar, it's going to be a little bit more expensive for them, and they're going to have to report slightly lower revenues and earnings and whatnot, and that affects their bottom line as well. So strengthening dollar, in fact, believe it or not, is actually not good news for US equities, because it all comes down to the concentration. Majority of the markets are controlled by, just the top 5-7 stocks. If you come over to market concentration, you'll see that the Magnificent 7 are now worth almost 32% concentration or weight in the S&P 500. That's a pretty big deal, So that's why if they're down 416 billion, the entire S&P 500 drags a little bit over $700 billion. And again, a lot of these companies derive their revenues from, majority of their revenues come from outside the US as well. This right here was the sector analysis. So a lot of that money went into utilities again. So a little bit of that risk off environment. Financials doing well, real estate doing well. Everything else was, of course, selling off very, very aggressively. So if you come over to SPX here, we're seeing a nice little pullback. We talked out support at 58.78, broke down further. Next target's going to be at 57.66. Very normal, very, very, very normal. I can't emphasize this enough. We've seen this happen over and over again. So if you're watching this video, I really want you to be ready with cash, and also refer to our shopping list. We've also got our shopping list here. As you can see, you can pretty much access this on the MoneyVest platform. So again, link's going to be down below if you want to join. Of course, access 29 stocks that I believe are the highest quality, and a lot of them are most likely going to be coming down to some of their fair values and their buy targets very soon as this market continues to sell off. So that's going to be available if you're looking for stocks to add to your watch list. What are some of the higher quality companies? This right here, the shopping list, is going to be very, very helpful for you. So support level next is going to be roughly around 57.66 on the S&P, and NASDAQ, of course, also coming down to that support of 18.6. Next target is going to be 17.7 for the NASDAQ as well. Now, for individual stocks, I'm actually going to be going over that in a weekend update. I'll be going over that over a weekend video in more detail. Magnificent 7, as well as Enphase, Costco, Palantir, SoFi. All these companies we're going to be talking about on our weekend update. But all in all, this market sell-off is very, very important. It is necessary. It is what is happens in a healthy pullback, healthy market. And that is exactly what we're seeing at the moment. So get ready, get excited. This is exactly what we wait for. And the MoneyVest index now at 3.57. Again, the lower it gets down to, the better that buy target, that buy signal is going to be for us. So I'll be ready. Hope you will be too. As always, happy investing, and make sure that you drop a like, subscribe to the channel. And again, link's going to be down below if you're interested in joining us. Happy investing. I'll see you all in the next video.